Welcome back to another series of videos about markets and their structures. This time we're dealing with MACD, one of the most popular indicators out there since God knows how long ago. I guess 20 years ago it got popularized. And when you see people doing technical analysis, uh, you'll definitely, at least 90% of the time, you see MACD on their charts. So you might have come to believe that it's a must-have in your toolbox. And in this video, I'm going to demystify a huge portion of what's been publicized as MACD's potentials and capabilities and magical powers, and how you can actually do the same things, not even with the same level of confidence and accuracy, but even better. And most importantly, I'll show you where and when MACD fails to perform and gives you misleading signals. Whereas if you use your eyeballs, um, you'll identify trend reversals and all of the things that MACD is aimed to achieve. So a quick summarization of what MACD is mainly used for is for divergence. And what's divergence? Divergence is when we are in a corrective move like this one in gold, then you'll see prices losing momentum, which means it's not moving as fast as it's used to. And it indicates a reversal of the trend, as you can see here. And the way the MACD works is uh, traditionally we draw some trend lines on the previous low, let's say it was here, and connect it to the new lower low. And we'll do the same thing with MACD, the previous low that MACD identified as your low here, and then we connect it to the corresponding low right here. And you see this divergence, so the price is going down, but MACD is telling you MACD's indicator is going up. So it's a divergence, it's a signal that the trend is reversing, and sure enough, it is reversing and it's going the opposite direction. But how can you first identify it with your eyeballs? If you followed my previous videos, I talked about the nature of corrective movements and how they do not traverse or move in the supposed trend direction as much as they should. If you take a look at here, this was, let's say, an impulsive move within a corrective move. This was a correction. This was another impulsive move. This was a minor correction, and this was the final move in that correction, which reversed here. So the thing you can do with your eyeballs is look at the previous impulse. The previous impulse covered a large portion of the price, and then it corrected itself and then made another move downwards. But if you look at the amount of price that it covered in its final move, it's not really significant. Let me get rid of this trend line. It wasn't really significant. Um, it barely went beyond what the previous impulse had done, and it already shows you divergence. If you're a newcomer and don't want to do mental or visual calculations and need something more concrete, there's a way to quantify this. Use expansion lines, which in some software packages is called Fibonacci expansion lines. We're not dealing with Fibonacci here, only the amount of price that it covers, and calculate the amount of price that the previous impulse covered, and look at how much of that price the new impulse, supposed impulse, covered, which here is about, let me expand this selection here, which is about 20%, which is not much. In a real impulse, we want something about 100% of the previous price movement, not 50%. We want something that's, let's say, gives us somewhere around 200% price points, somewhere around here. But This chart failed even to get to 40, 50% price point. So we clearly see a divergence when the movement went downwards here. So it's a huge indicator that a reversal is about to follow. So this is one way of quantifying it if you're not comfortable with your uh, visualization with your eyeballs. Uh, so this is an easy way to do it. Let me show you the same example with a real impulse that covers a significant portion of the price. So if you look at this impulse and this correction, the following impulse was really strong. How can we know that? We do the same thing that we did right now. We grab our expansion tool, we draw the expansion tool on the previous impulse, and as we can see, the newer impulse, the new impulse starting here and ending, let's say there, went about 200% point. So covered almost as much as the previous impulse. So we know that there's going to be some continuation afterwards. And sure enough, if you draw the trend lines using the chart and MACD, connecting lower lows, and do the same thing with MACD, connecting lower lows in MACD, which is not visible here. It didn't identify this one as a low. Well, let's say, I don't know, somewhere around here. And connected to the corresponding low here, you can see there's convergence, not divergence, meaning that the correction trend is going to continue for the next wave of movement. So this is where MACD performs well, but we don't need it. We can just get rid of this and deal with price instead. Look at the chart, impulse, correction, the next impulse powerful, 200%, and the following impulse not really powerful, barely covering 50%. So we see the divergence with our eyeballs. But there's even more to MACD, and it is how it misleads you most of the time with different charts. Let's go to silver now. Going to silver, you can see we are in a downward trend. Long-lasting downward trend. And who knows when the trend is going to be reversed. I have a full video on silver and why and how it is a good commodity to buy right now, because it's trading at a really low price. But have a look at its chart. Let's say in this downward movement, this was our previous impulse. So let me show you here. This was our previous impulse going down to here and then correcting and then making another attempt to make a lower low, which it did around here. So is it a divergence or is it a continuation? As you can see, the previous impulse covered a significant portion of the price range, but the new impulse covered barely like 5 or 6% of the previous impulse's movement. It only made a fake out of this previous low, and it reversed. Again, if you're not comfortable with doing it with your eyes alone, you can draw the expansion lines, Fibonacci expansion lines, and sure enough, you can see here it's 13%. It's not even covering 13% of the previous impulse. So it's a powerful signal to tell you that the trend is about to reverse. But let's see if MACD can identify this reversal and this divergence too. And you're going to be surprised. So let's do the same thing with MACD, the same thing that we did with gold, this time with silver. So we connect the lower low, previous lower low, to the new lower low. And we try to do the same thing with the MACD indicator. First off, it doesn't identify this low as a huge or significant low. So this is the first problem. It identified this low, which was insignificant and part of a smaller time frame, as our dip here, which is kind of the first signal that is misleading you. But let's take it at par value. So let's connect this low corresponding to this low corresponding to that. And as you can see, it's a flat line. It's not giving you any divergence. And I meant to record this video when it made a fake out and reversal. So these two candles, I procrastinated. I didn't do it. Now we have some new information. Here's another fun fact about MACD and other lagging indicators. The fact is they change over time. What do I mean by that? What I mean is, if the price reverses and goes upwards, MACD will show you a reversal signal and go upwards. So it'll update its indicator automatically. If it continues to go downwards and ignores this retracement and goes downwards, it'll not even show this portion that we're seeing right now. It'll be something like this one right here that goes down. I remember back in the days, like 6 or 7 years ago, I would put a buy order somewhere because MACD told me so, and there was divergence and confirmation and everything else. And I was trading on an hourly time frame. Then I would come back to the chart and I would see, oh, the divergence is not there anymore. And I would get like conspiratorial, think, oh, maybe somebody's messing around with my chart. The truth was, something was messing around with my chart, and that was the lagging indicators like moving averages, MACD, stochastic lines, or Bollinger Bands, whatever you might be dealing with. So they do update themselves. Here's a peril if you're analyzing and backtesting with, let's say, MACD. When you're backtesting, since it's already updated, so let's say we're backtesting in this area, we have all the price information, it's already updated. So it's already made all its corrections in these portions of the chart. So when you backtest, you see, oh, it's performing pretty well. It's identifying divergences and everything else. It's a good indicator. But in real time, when you want to, at the moment of truth, when you want to place that risky buy or sell order, you'll see something like this. When it gives you divergence, you put a buy here, and then a couple of weeks later you come back and see the divergence is gone. The indicator has shifted its face, has kind of unmasked itself and switched its direction like nothing happened. Like those people who attempt to predict the forex market or any other type of prediction and forecasting, and they cherry pick their predictions. So they remove all the comments and videos that they uploaded that they failed. They only present you with the ones that worked. This is what's going on with MACD. So I guess the biggest peril, if you trade based on MACD and identify divergence based on MACD and not your eyeballs alone, is that, let's say 50% of the time, it misleads you. So here it failed to identify this as a divergence, which it clearly was. It was a fake out. It didn't cover even 13% of the previous price movement, and it's not showing you any divergence, and it's not even formed a low here yet. It'll probably form a low like this one, which is clearly a low, way ahead into the future, when you're no longer interested or the trade is not sexy and interesting enough to be initiated. So, lagging indicator, misguiding, you name it. So, why bother with MACD while you can just click delete here, get rid of this? Because when you have MACD on your chart or any other indicators, I see people with five different indicators. It looks sexy to outsiders, or people who look at the chart and say, oh, he knows what he's doing because he has 10 different indicators. But the problem is, when you're looking at this chart, you're looking at two charts simultaneously, and it certainly divides your attention. And its cognitive load is at least double if it doesn't have any synergistic effect. But when you remove this, now you can focus solely on the chart. And I showed you that the chart tells you way more information than such indicators do. And the chart does not really mislead you or misguide you in any way. So this is my take on MACD. Anything else that I want to add? So you know how to quantify it, you know how to identify the divergence as we did here. Um, it's not formed yet. I'll definitely post an update if or when it actually goes up, and I'll record a video about that. And this is one of the instances for which it actually did go up, and the divergence was correctly identified using only eyeballs. So you get best of both worlds. A more simpler strategy, more simpler chart, and a more powerful technique. So here you see it. This is the lower low, and let's get rid of the previous, the initial impulse to do a recap. This is your lower low. This is your Fibonacci expansion lines for the previous impulse projected here, and it covered about 20%, which is not enough. What does a real impulse look like? When we do not have a divergence, when we have a convergence, let's look at this portion of the chart. So this was one wave, impulsive wave correction, a three-wave correction, and then we have another impulse and hopefully some correction in the future. As you can see here, if I do the same thing that I did before, if I get my Fibonacci expansion tool, start with the initial impulse and expand it here, as you can see, I'll need some trend lines here. Give me some trend lines. There we go. So this is our first impulse. This is our second impulse. I don't know whatever you want to call it, the start of the impulse. And for right now, we've not even had the correction yet. It might go even more than that. But for the information that we have right now, it's covered more than 200% of this previous impulse. So we are certain, we are sure that there's no divergence between this impulse and this impulse, and we're not going to see a reversal here. Thank you for watching this video. If you click this like button, it's really going to help me, motivate me to put out new videos more frequently, or even put them out at all, because I'm doing this for educational purposes. If you like it, or share your positive and constructive feedback in the comment section below, and subscribe to my channel. Um, that's going to be the only motivation that I'll put out new videos at all. So thank you for watching. I hope it helped. If you have any questions of any sorts, please share them with me. I'll be more than happy to address your questions in the videos to come. Stay